Thank you everyone for being here this morning. As Amy mentioned, we know it's first panel of the day, first session after lots of dinners last night, so thanks again for being here. My name is Dylan Cox. I'm the head of private markets research at PitchBook. We've got a wonderful panel planned for you in just a few moments, but before we get there, I wanted to walk you through the state of venture in Europe through the lens of PitchBook's data on deal-making valuations and fundraising. The theme right now that we're seeing in markets is that falling valuations and a risk-off attitude, lead to a shortage of capital for growth stage companies. This is very different for early seed and angel stage companies, but that sort of growth stage, call it Series E and later, pre-IPO, that's where we're really seeing the crunch, and we'll dive into that a bit more here. Setting the stage for a moment with some of our fund performance data. Here we're looking at rolling one-year performance for global venture funds. Venture has been, along with private equity, one of the top performing asset classes over the last 10 years, outperforming all other alternative strategies, as well as public markets over that time frame. But venture saw the biggest hit of any private market strategy in 2022. Private market data, performance data is lagged by a couple of quarters because of all the LP reporting that has to happen. So this data is only through the first half of the year. Annual performance, as we're showing here, is still about positive 3%, which you might not expect. But with some, preliminary quarterly data from the second half of the year, we expect that to turn negative in Q3 and Q4 of next year. Taking that quarterly look, as I mentioned, we're seeing negative NAV performance for those venture funds in each quarter of 2022, and you can expect that to continue into Q4 of last year. And depending on what happens in public markets here for the rest of Q1, I would say likely Q1 of 2023 as well. This is the first time we've seen 3 consecutive quarters of negative growth since the global financial crisis. So really a changing of the tide in terms of venture performance. Another way we can get a sense of how venture is performing is by comparing venture companies or what were recently venture-backed companies to broader public comparables. So here in the blue and green bars on the bottom, we've got our venture-backed IPO index. That's formerly venture-backed companies that IPO'd in the last 2 years. We're also comparing companies that have gone public via SPAC in the last 2 years. And both of these cohorts of companies that are most similar to that growth stage within venture have underperformed, whether you look at FTSE, Morningstar European indexes, the NASDAQ, as Emmy mentioned earlier, was down considerably last year, but venture fell by more than the NASDAQ, S&P 500, you name it, your public comparable. A big reason these companies sold off by so much is because the premium put on revenue growth by public market investors really shifted to a focus on earnings and positive free cash flow last year. So here we're looking at the price to revenue multiple of that cohort of previously venture-backed companies that are now public. It reached really what is, I would consider to be an egregious level, 165 times revenue in mid-2020, and has come back to earth really to 16 times revenue by the end of 2022. This really is more in line with longer term averages, right? I don't think anyone thinks that 165 times revenue, even for a fast growing software company, is a sustainable multiple. So things have sort of come back down to more sustainable valuations. I think many public market investors we're hearing are actually excited about this because projected future performance for this cohort of companies was really terrible when you're trading at over 100 times revenue. As I mentioned, public market investors have really gotten away from that growth at all costs approach and really focused on free cash flow and earnings. But cash flow hasn't changed for this cohort of recently venture-backed companies, and we can assume that it hasn't changed for the cohort of still venture-backed companies, at least at that growth stage as well. So again, not a pretty picture for growth stage companies. Exit value, liquidity events have also fallen, did also fall in 2022. Most exit value in venture is driven by IPOs, as you can see in the sort of turquoise bars here. We reached a record level of venture-backed IPOs in 2021, regardless of geography, whether you look at European exchanges, US exchanges, or Asian exchanges. Everyone set a record. It really helped that those price to revenue multiples were at over 100x briefly in 2020. If you're a founder, if you're a VC, of course you want to take advantage of that pricing, right? But that's really slid the other way in 2022, and we saw progressively fewer and fewer public listings. Deal making, unsurprisingly, has also taken a hit, down 56% in Europe from Q1 to Q4 of last year. We should caveat, though, that most of this decline has been at that growth and late stage, angel and seed and early stage deal making all the way up through about Series B. Actually saw increases last year, both in terms of valuation and the number of deals happening, the capital deployed into those companies. So there are some pockets of, shall we say, optimism in the venture market. They're just sort of shielded in the aggregate data because so many of these companies, these venture growth, late stage companies, are many hundreds of times larger than, say, a seed-backed startup. A big reason that this venture growth cohort saw a big pullback in deal making is because the investors who had come into later stage venture, these non-traditional investors, had really pulled out of the venture markets when public markets took a hit in early to mid 2022. These non-traditional investors here we define as private equity firms, mutual funds, sovereign wealth funds doing direct deals, even some hedge funds who had set up dedicated venture arms. Some people call them tourist investors, right? Those funds and firms who had not always been exclusively focused on venture, who had come into the space, who, in our view, had really chased the performance of the couple of years prior, who had started to lead deals in some cases, and sort of prided themselves on not having the price discipline of many venture investors who had been in the space for a long time. The market now has a shortage of capital supply. Again, I'll caveat, this is mostly true at the later stage and the venture growth stage, sort of pre-IPO. What are we looking at in this chart? The way to interpret the right-hand numbers is that there's 2.8 times more capital being demanded by startups than there is available from venture companies, venture investors, excuse me. So the way we're getting to capital supply in this chart is just taking the deal value, the capital invested into venture-backed companies in any given quarter. And the way we get to capital demanded is an estimate. We take deal flow over the trailing 2 years. We estimate what the valuation step-ups and deal size step-ups are in a normal environment. We estimate the time between rounds, and we get to an estimate of what companies are likely looking to raise if the market were more amenable. Because of this capital supply, we expect a lot of these companies to raise down rounds, or as Emmy mentioned earlier, maybe raise at a headline flat or slightly up valuation, but in such a structured way that it's effectively a down round. Valuations at the top of the market are correcting, even on a headline basis. At that growth stage, median valuations pre-money are back to about 28 million euros. As you can see, though, in the yellow, turquoise, and black lines, those are still on the rise for earlier stage companies. So a lot more healthy deal making. Perhaps those angel seed, Series A and B companies didn't see quite the uptick in terms of valuation that we saw at the venture growth stage because they're sort of more immune to public market volatility, both on the upside and the downside. Terms in deals have shifted to become more investor-friendly as opposed to founder or startup-friendly. On the y-axis, the scale here, 100 is investor-friendly, 0 is founder-friendly. And we're at the most investor-friendly point in terms of board observation rights, liquidation preferences, valuation step-ups, and time between rounds, and a few other terms. We're at the most investor-friendly point that we've been at since before COVID. So things, you might say, are turning a bit more healthy or a bit back more towards normal, what they were like before a couple of years ago. Venture fundraising, despite all of this, set a new record in Europe in 2022. This is really a tale of two halves in terms of last year, though. Three-quarters of this 25.5 billion euros was raised in the first half of this year, and then Q3 and Q4 saw progressively fewer commitments from LPs into closed-end venture funds, which you might expect given all the volatility. Public markets really didn't start selling off in a big way until the end of Q1. The war in Ukraine started around then too, and so it wasn't until, call it June, July of last year, when I think everyone really priced in all the volatility that was happening. LPs, in a very real way, started dealing with the denominator effect, slowed commitments to new funds, and we expect that slowing to continue into 2023. Lastly, potentially one bright spot for the industry this year is that there's a record amount of dry powder, 54 billion euros earmarked for European venture funds right now. We expect this capital to support the startup ecosystem, especially at the earlier stages. It might take a while for those venture growth stages to come back, but there is, a lot of dry powder waiting to be deployed, and deals will continue to get done, even if at more earthly valuations and more terms that are in line with the longer-term trend. So a few predictions, a bit of an outlook for next year. First is that we believe the venture market will continue cooling as a new balance of deal making is found. VC fundraising, as we mentioned, has been robust, but it's set to slow in 2023 and has already begun slowing in 2022. We expect more down rounds, more highly structured deals. We'll get to that in a moment with the panel. Startups, of course, there have been a lot of layoffs, even at high-profile technology companies who seemed invincible a couple of years ago. So we expect to see more down rounds and layoffs. And that growth at all costs narrative has really been replaced by one more focused on sustainable earnings, positive unit economics, and free cash flow.